Hey everybody, Marty Mazur. Good afternoon, March 29th, 2016. Got a lot to talk about, but I'm going to try to do it fast. And I won't give you all of it because that would take all night, and I know none of you would be interested in that. But let's start. Actually, let's just jump right in with the chart, and I'll talk as I show you this one. That's the Citigroup Economic Surprise Index for the U.S. I've shown you this before. What it illustrates is to the degree that actual economic data as it is released differs from the consensus among economists and from their opinion. So when the economic surprise index slopes lower, that means the economy is performing worse than economists had expected. And when it trends higher, that means the economy is doing better than economists expected. So this is the economic surprise index from the beginning of the year. As you can see, in the beginning, it wasn't so great, but everything bottomed at on February 5th. I say everything bottomed. This indicator bottomed and then really has shot substantially higher. Hence my expectation at the Fed March meeting that Janet Yellen was going to announce that she and her committee are feeling even more confident that they need to raise interest rates in 2016 than they did at the December meeting. And that's why I kept saying that what they did flew in the face of the data. She did it again today at a speech at the Economic Club of New York. Some people thought that since other governors have been coming out and sounding more hawkish, that they were kind of setting the stage for her to maybe sound a little more of an alarm on interest rates. She didn't. In fact, if anything, she was even more dovish. And you may have noticed that the market liked that. The Dow was up almost 100 points. NASDAQ was up huge, 1.7%. And the S&P was up almost 1%. So a very positive day for stocks. And it didn't start out that way. It was when she started talking that the market really began to take off. So why would that be? Why would I be telling you that the U.S. economy, while anything but going gangbusters, is not as bad as people thought it would be at this juncture? Why would the Fed then not be more comfortable with raising interest rates? So I'm going to introduce another line, and this, I believe, explains why. And she talked about this today, but I think this is the chief reason. This yellow line here is the Bloomberg dollar spot index. So this basically is the US dollar against 10 of our major trading partners' currencies. And if I just play with this arrow, we can see that the correlation has been quite negative of late, meaning the economy seems to do better right now at this juncture when the dollar goes lower. And I think that is the relationship that the Fed is banking on going forward. So if they were to raise interest rates when the rest of the world's central bank, or most of them, are keeping rates very low and in some cases in negative territory, well, the currency textbook would tell you that interest rate differential, the fact that you get higher interest rates in the US, would force capital away from economies, some of which badly need capital, over to the US, support the dollar, hurt the global economy, and the U.S. economy in the process. So I think the Fed is purposely downplaying some of the data. They're not warning of recession. They're just talking about sluggishness. And I'm not going to say the market isn't or the economy isn't somewhat sluggish, just not as sluggish as anybody thought it was going in. Not as sluggish as it was in December when they raised interest rates and said they were going to raise them 4 times this year, and they've completely backed away from that. So, folks, I think it's the dollar. I think that is their chief concern, and they want to keep it lower for longer and allow this economy to really get its legs underneath it. So we'll see. It'll be interesting commentary going forward. So let's now look at the stock market real quick. Here is my 1-year chart, and today, this bar going up and down. By the way, the bottom is the low of the day, the top is the high. The little notch to the left is where the market opened. The little notch to the right is where it closed. And as you can see, it closed right near the day's high. And as you can see, we're getting real close to this downward trend line. I have to tell you, if the market breaks that with some momentum, you could see, I think there's a lot of capital left to come into this market. I know short interest is still plenty high. Shorts may have to cover, and we may be talking about May all-time highs in the not too distant future. And I've been warning of that of late. But I also have been telling you that I think the near term, the bias is to the downside, and I think I've been proven relatively wrong. Although I'll show you that we have had some downward volatility, but not to the extent that I would have expected before we began our move higher. This 200-day moving average line looks like it could end up being support for the market, and the 50-day is sloping in the right direction. When the 50-day moves above the 200-day, a lot of technicians think that's a very bullish sign going forward. I want to take a second and introduce you to one I haven't showed you before. It's another technical indicator that's worth tracking. It's called on-balance volume, and it basically gives you a sense as to whether the underlying volume, the actual number of shares trading hands each day, support the move. Moves are more meaningful when the volume is greater in both directions, particularly when the market's going up, though. And so this on-balance volume catches the volatility or the momentum in the volume. So essentially, you look for it to confirm the direction. And what I did here is let me just add the trend line up here, is I drew just the last few days sorry folks, I'm just going to work on this while I'm talking. So from the 21st to now, so 8 calendar days ago, you can see the market is relatively flat. It's actually a slight upward slope. It doesn't really look like it there. But look at the on-balance volume. What this says is that from a volume standpoint, the down days have been more meaningful than the up days. So we can look at just about any chart. This is just, again, the 1-year chart. And we can probably find some times where there was a signal there that if you were a short-term trader, you might have heeded. Like, for example, here is the market going nicely higher, but here's on-balance volume basically staying flat, if not from peak to peak. Yeah, just basically flat. That would be a signal that this is not a meaningful move, right? And then look what ultimately happened as things came down. You notice the on-balance volume slope was steeper than the slope here, and sure enough, we had a pretty good correction to start the year. And then you had basically this one, probably the indicator was right about where it should be. And I guarantee you, I can go back, and we can go back through lots of times where I might find a relationship like this. Oh, this is very short term. And it didn't happen that way, because this is bearish. This would suggest on a very short-term basis that the market maybe should be selling off, that it's poised for a sell-off. But there's no doubt that we could have another Fed speaker tomorrow. We could have news out of Europe or out of China or somewhere else that really sends this market even higher with more volume, and then we would just forget that we even had this conversation. Another one that I've introduced you to before is the MACD, the moving average convergence divergence. And I told you that, let me get rid of this. I showed you here that was actually showing some upward momentum, while the market from here to here did not suggest that. And this was a really good sign. It turned out to be a very accurate sign that the market was about to bottom and move higher, and how has it ever. But then it began tapering off a bit before the market did. Now, when the MACD line, the white line, crosses below the signal line, that is a bearish indicator when it happens, and you can see we're flirting with that very, very closely. So it'll be interesting to see the next few days, but you can see that this is telling us that this rally is getting long in the tooth, and I think it gives a real short-term bias to a downward move. But I can point to breadth, as I have recently, and tell you that to me is a very strong intermediate term signal that this market can gain some strength. And I'll say it again, there's a lot of liquidity. Short interest is high enough to where we could see this market continue to bounce. In fact, let me check. The pre-market right now has U.S. futures on a fair value basis, up the Dow up another 125 points if the market were to open right now. So clearly, we're seeing some strength. And by the way, oil went down today. So that firm positive correlation between oil and stocks isn't there nearly to the extent it was just a few weeks ago. So let me wrap up by bringing a little closer in on the short-term chart. So my 60-day, 60-minute chart I've been talking a lot about this upward sloping wedge pattern being bearish, and then we broke down below it, but we really didn't do so in a huge fashion. It's not like shorts got rich or people lost a lot of money. So now it's time to get rid of that one and move this line down to that support line, and you can see we still have that upward sloping wedge pattern, which shows that the rally seems to be petering off. So we need to break through that with some force or soon, or the tendency. Doesn't have to be. I'm sure I can find lots of upward sloping wedge patterns where the market broke out to the upside, and there could be some good macro news that makes that happen. But all things being equal, the likelihood in the near term would be to the downside. Let me, oh, I don't think I need to. What I was going to do is show you some of those overbought, oversold indicators, and the market on a near-term basis remains overbought. And after today, it's back further into that territory. So, folks, we'll see. My purpose here is to give you some perspective on the near term, so it doesn't drive you crazy as it happens. But I do think, technically speaking, on an intermediate term basis, I think the market's looking better. On a short-term basis, I think there's maybe a downside bias. And as we get closer to this election in the U.S., we'll be having, of course, very interesting conversations. And in the meantime, I'm very interested in the Britain referendum on June 23rd to see how that goes. And that's a vote. The people will vote as to whether or not to stay to the European Union. And that has all kinds of implications as it relates to currencies and global markets. So stay tuned for my commentary on that. Thank you all for watching and listening, and I'll be back very soon. Take care.